Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to asset and financing mix options. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We have the information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. Notice we have 2 tabs down below here. You may have 4 tabs if you're following along with the Excel worksheet. The other 2 tabs are going to be the answers to the Excel worksheet. We only have the 2 tabs here being the practice problems. If I go on over to the second tab, we got a similar tab over here, but the numbers will be different. So we'll work 2 problems as we go. First tab, we've got our information on the left. We're going to be talking about basically the mix between more aggressive plan and a less aggressive plans with regards to the asset mix, the assets that we have, and the financing options. So typically when we're thinking about the asset side of things, we may have an option then to have a more, less aggressive plan and a more aggressive plan with regards to our asset mix. And then we might have a similar option with regards to our financing. If we have to have financing, then the question is, we might have a more aggressive or less aggressive financing, and we could start to think about the combination between these 2 types of options, the aggressiveness of our asset structure and the financing. Now, on the asset structure side, the flexibility or the trade-off is going to possibly come with us either having more or less fixed assets, having more liquid or less liquid assets. If we have less liquid assets, we might be doing so to get a larger return. In other words, for example, we might be locking our assets down in something like more property, plant, and equipment, which could help us to generate a longer term return due to the fact of leverage on the property, plant, and equipment, and the less reliance on variable costs such as possibly labor. Or we might say, hey, I would rather have more liquid assets, meaning we'll have something that's more readily cash flow available so that we lessen the risk of us not being able to pay our obligations and whatnot, and we lessen the risk related to the leverage of having a lot of property, plants, and equipment, a fixed cost possibly, and we instead have the variable costs, and that could result in a less possible return, but more flexibility in case there's a downturn in the market or something like that. We've talked about that with leverage in the past. On the financing options, we can have a similar type of scenario. If we have to take out a loan, we might have an option that we can take short-term financing, which usually has a lower interest rate, but possibly have then the flexibility of us needing then to worry about the fact that it could go up in the future. It could flex in the future versus us having a long-term financing where we basically lock down the interest rate and we don't have to worry about the flux, although we'll have a larger rate. So if we start thinking about these 2 things, then we could start thinking about, well, what would be the combination of us picking up this risk, and we might be more comfortable with one side of risk on the financing or asset side, depending on the type of industry that we are in. So let's consider some different kind of options here. If we're going to do the most aggressive option, we'd say, okay, we're going for it, right? We want to do the aggressive option, which means we're going to have less liquid assets. We're going to put more of our money. We want to take out loans. We want to put that money into fixed assets. We want to buy the best, right? We want to buy the good fixed asset stuff, and then and more leverage in terms of operating leverage our company, and then we're also going to finance it with short-term financing, and that means we're going to have the lower interest rates, and we're going to hope that the interest rates don't go up, and we're going to try to maximize our returns in that way, right? So you could say, okay, well, what would that look like if we have the estimated returns before interest then that we can consider? We'd say, all right, well, the estimated returns, if we have the assets at the 4,700, we think we're going to say, hey, if I get that 4,700, we invest that in equipment or something like that, we think we can get a return on the assets at that 18%, the higher return rate. If things go badly, then we're more at risk because we've got our assets are more locked down, but so when they're not as liquid, in other words. But if things go well, then we think we're going to get that 18%. So that's going to be the home tab numbers group, percentifying it, home tab font, and underline. And then that's going to give us our estimated return before interest and taxes, here, but I'll say interest. I'm going to go home tab, font group, and undo the formatting there. And then I'm going to go This equals the 4,007 times the 18%. We've got the 846. And then I'm going to select these three. I'm going to go to the Home tab, the alignment, increase the indenting. I'll select this one, Home tab, alignment, increase the indenting. So that's going to be on the return side. Now, if we go to the financing costs, let's go to the financing side. We're going to do the more aggressive financing, meaning we're going to take out a loan. The loan amount is going to be and whichever option we choose, it's going to be the 4,700 is going to be the loan, meaning we're going to finance all of the assets, right? We're going to say we're going to finance the entire thing. So we're starting the business. We're going to finance the assets here, and we think we're going to get a return. We need a loan for the entire 4,700. The rate then, we're going to say the rate is going to be equal to the 10% if we pick the short-term financing. So I'm going to go to the Home tab, Numbers group, 10%, and then Home tab, Font, and Underline. And then we'll say this is going to be equal to the 4,007 times the 10%. And we got the estimated financing costs, let's say. And then I'm going to select these three. Home tab, Alignment, increase the indenting. This one, Home tab, Alignment, increase the indenting. And then I'm going to say the estimated earnings, then after interest, before taxes, is going to be equal to the 846 minus the 470. Let's put an underline here. And there we have that. So that's going to be on our aggressive plan. Let's say we do it, and then we could see the kind of combinations we might have here. Let's do a less aggressive plan. This time being, we want the more liquid assets. So we're more comfortable not locking down all of the assets rather than buying a lot of equipment possibly. We're going to do a little bit more manual labor type of stuff in order to produce our inventory possibly. So instead of buying the best equipment to manufacture the whole thing, we'll depend more maybe on labor or something like that. And that means that we think we're going to get a lesser of a return due to having less leverage involved in it. But if things go down, it's less likely that we're going to have as much of a problem on the downside. So we're measuring our risk there. So we're going to say, all right, let's do this again. We'll say this will be equal to, I'm just going to pick up the same calculations. The assets are going to be the same assets here of the 4,700. And then we're going to pick up the rate. So I'm just going to say same format. We're going to say return on assets is going to be then the 14%. So the lesser return on the assets. Home tab, Font group, underline, Home tab, Numbers, percentifying it. And that's going to give us our estimated, I'm just going to, let's make it lowercase return before. Actually, I can say this, let's do this equals the same line up here. And then we can indent, selecting these three. Home tab, alignment, increase the indenting. Let's indent this one. Home tab, alignment, increase the indenting. Calculating this will be the 4,007 times the 14%. So a little bit lesser of a return. Then the financing costs, we're going to say on the financing costs, we're going to take the long-term financing. So this is going to be actually the least aggressive plan, because we're going to take the long-term financing and lock down the rate so we don't have that variance possibility for the rate. So this is going to be the loan. We're going to pick up then the rate, and that's going to give us the estimated financing costs. Let's select these three and indent those. Home tab, alignment, increase indenting. Here, Home tab, alignment, increase indenting. We're going to say that the loan amount then for the long term is going to be the 4,007 times the rate of the 12%. And I'll go back on that cell, go to the Home tab, Font group, and let's underline it, and also go to the Numbers group and percentify it. We'll multiply this out. This is going to be the 4,007 times the 12%, and that's going to give us then our estimated earnings for this plan is going to be the 658 minus the 564. Let's underline here, Home tab, Font group, and underline. So you can see, of course, we have substantially less, right, estimated earnings but we have less risk involved there. So that's going to be basically our trade-off. Then let's consider so we can have some in-between type of plans. So these are the two extremes. We can see a combination, of course, between these as well. So we could say, well, what if we did the low liquidity and long-term financing? Low liquidity, long-term financing. So in this option, we're saying, hey, look, we really think our competitive advantage is in that we want to purchase the equipment and then beat out the market with the better equipment. But we think we would like to be less risky in terms of the financing options and lock down the financing options. So we could say now we're being more risky on the assets because we want to lock down our assets. We think that's going to be our competitive advantage, but we want to lessen the risk on possibly the financing. And so if there's a fluctuation in the rates, we should be okay there. So we're going to say, all right, let's pick up the same. We got the same text here. We're going to pick these up. And this is going to be then the assets are still going to be at the 4,007. So I'm going to pick that up here. And the rate is going to be, let's pick up the rate from over here. It's going to be the less liquid assets. So we got the less liquid assets, meaning we're buying property, plants, and equipment. We're locked into it more in that case. If they're less liquid, we can't use them to do other things in case of a problem. So we're going to buy the less liquid assets. We'll percentify this, going here. We're going to go to the Home tab, numbers, percentifying it, underline, Home tab, font group, underline. Let's multiply this out. This is going to be the 4,007 times the 18. Let's indent these items, selecting these. And we could start using the format painter. So let's start doing that. We'll select these three, Home tab, clipboard, format painter, and I'll paintbrush these three, and it'll give me that nice formatting for us. And then we're going to say, all right, let's do the same thing here. Let's pick up the financing costs. It's going to be the loan and the rate, and that's going to give us the estimated financing cost. Let's format paint those cells, these three cells, because they have indentations. Home tab, clipboard, format painter. I'll paintbrush these three cells. So there we have the formatting for us. The loan is going to be the same at that 4,007. The rate, however, we're going to be using the less risky but higher rate long-term financing, the 12%. And so then we'll percentify that one. We'll go to the Home tab, font group, underline, and percentify. And then we're going to multiply this out, the 4,007 times the 12%. Let's underline here, Home tab, font group, underline. Let's say that's going to then be the earnings. It's going to be equal to the 846 minus the estimated financing. So obviously that's somewhere in the middle, and you can see how that could be another strategy that we might have. So instead of going all risky and all, less risky, we can try to pick somewhere in the middle depending on what we think our market strategy will be. Where's our competitive advantage? So then we might do the other one, which of course would be high liquidity and short-term financing. So we might say, hey, look, I want to have more liquid assets here. And so we won't be investing in all equipment. Rather, maybe we have more labor, and then that's going to allow us to free up some of our assets, which will be more liquid type of assets in case there's a problem, and possibly have less operating leverage in the company, which could lead to less increase in good times, but possibly less problems in bad times. But we want to finance it. We think we want to take advantage of the short-term financing rate and hope that the short-term financing rate plays out for us. So what would that option look like? We're going to say this will be equal then to the estimated return before. We're going to say the assets and the return on assets, and then we'll pick up the estimated return before interest. And somehow I missed this one. And then let's select these three. Let's go to the Home tab, clipboard, format paint, and format paint these three. Then we're going to say that the assets are still going to be that 4,007. The return on the assets now is going to be the 14, because we're going to have the more liquid. So we're going to pick up that 14 again. And let's go ahead and go to the Home tab, numbers, percentify that. Let's go to the Home tab, font, and underline it. And then we'll multiply this out. This is going to be the 4,007 times the 14. So there we have that. And then we'll say that the second component being the financing costs, we're going to have the loan. we're going to have the rate, we're going to have the estimated financing costs. Let's select these three, format paint it, home tab, clipboard, format painter. We'll select these three to paintbrush them over. Then we'll say the loan is going to be that the 4,007. The rate now, we're going to be picking up the shorter term, more aggressive rate at the 10%. And we're going to go to the home tab, numbers, percentifying, underline, and then we're going to have then the estimated earnings. Let's say this is going to be the 4,007 times the 10%, subtracting these out, the 6,558 minus the estimated financing, and that gives us the 188. Home tab, font group, underline. Once again, that puts us kind of in the middle here. Now we've looked at kind of 4 options on this different kind of mix that you might have, but notice it'll often depend on what, one, your risk level is, and 2, what industry that you're going into. So like we say, it might be basically, you might think it's your strategy to go in and be able to beat the market out by basically buying the better equipment, right? And if that's the case, then you're going to probably have to lock down the equipment. You're probably going to have less liquid assets, and you're going to put all your money into the equipment, because that's going to be the point. And then you can try to think about whether or not you want to be aggressive or non-aggressive on the financing options, taking out a short-term, possibly flexible rate loan, or long-term. Or you might have some other type of business where you're saying, hey, look, I'm going to go in and I'm going to do more work on it with less of the fixed costs, and that could be advantageous depending on the economy, what the economy is basically going to doing. Or maybe you might have more differentiation between what you're doing by not completely making it an automated process or something like that. And you can just say, hey, I can then take more liquid assets by buying less equipment possibly, and then lock down my assets less. In that case, have more liquid assets in case there's some kind of problem, and possibly be managing through something like hourly wages, which could lessen the operating leverage, which could have benefits depending on what the economy looks like, and then think about the financing options. So let's do it again. This time we'll do it a lot quicker, and we'll practice kind of the formatting of this. So we got the same process. We got the assets up top. We have the 2 plans on the assets. We can have a return on the assets at 15%. If we have less liquid assets, basically buying more equipment, we can think of that. Or we can have, but that's going to come with risk. Or we can have more liquid assets, possibly locking down less of our assets in equipment, so that we are more likely to be able to meet our obligations and not run into problems. And then the financing options, the short-term financing, typically having a lower potential rate but more risk, with the rate possibly being flexible, and then the long-term rate. So let's do this again. We're going to say that the most aggressive mix between these two, between the asset and the loans, we could say, all right, the estimated return before interest and colon, and we're going to have the assets are going to be the 1,500, and then we're going to say the return on assets is going to be the 15% to give us the estimated return before interest. Let's percentify this one. Home tab, numbers, percentify, home tab, font group, underline. We're going to select these 3. Going to go to the home tab, the alignment, indent. Select this one, home tab, alignment, indent. We will then multiply this out. This is going to be the 1,500 times the 15%. There's the 225. Then we have the financing cost, colon, which is going to be the loan amount, and then the rate that we'll have, and that's going to give us the estimated financing cost. Let's select these 3, and I'm going to go to the home tab, alignment, increase the indenting of this one. Home tab, alignment, increase the indenting. The loan is going to be for this 1,500. If we do the most aggressive short-term plan, we're going to be picking up the 15%. Let's percentify that. Home tab, numbers, percentify. Home tab, font, underline. Then we'll calculate this out. This is going to be the 1,005 times the 9% for the 135, and that's going to give us the estimated earnings, which is going to be the equal to the 225 minus the 135. Underline here. So I'm going to go ahead and home tab, font, and underline. Okay, so now let's do the least aggressive plan. This should be less. This should really be least aggressive plan. And so now we're gonna say I'm gonna do the formatting first. I'm gonna say this is gonna be equal to the first item here. I'm gonna copy that all the way down because it's gonna be the same all the way down. So I'm gonna autofill all the way down. Then I'm gonna copy the formatting of the entire thing. I'm gonna copy the formatting of the whole thing this time. Home tab, clipboard, format painter. And then I'm just going to format paint. I just got to click the top one because it's going to have the whole box is going to be the same. And then we're going to say, all right, here's the least aggressive. We're going to say, well, the assets are still at the 1,500, but we think we're going to get a 12% return if we are less aggressive here. So 12% return. We're going to say the 1,500 times the 12% is going to be the 180 here. And then we will say that the financing, we're still going to take out a loan for the whole thing. The loan is going to be at the 1,500. We're going to lock down the rate, take the long-term loan, which is going to be the 11%. So we've got this equal to the 1,500 times the 11%. And then we have this equaling the 180 minus the estimated financing. So that's if we take the least aggressive plan. Let's pick one in the middle now. Now we're going to say, well, what if we had the low liquidity and the long-term financing? Meaning we're going to be aggressive on the asset side of things, putting more money possibly in equipment, and less aggressive on the financing side of things. So we're going to say, all right, this is going to be equal to this one. I'm going to copy that down this time. I'm going to say Control C, down arrow, hold down Shift, down, 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 Control V. Then I'm going to format this entire thing. I'm going to select the entire box, Home tab, Clipboard, Format Painter, and I'll select this entire box and format paint the entire thing. And then we're going to go to the assets. I'm going to say that's going to be equal to the assets over here, 1,500. We're then going to be picking up the percent. I'll pick up the percent all the way to the right. We're going to be taking the less liquid assets, the more aggressive plan on the asset side of things, which will be equal to the 1,500 times the 15%. And then on the loan side, the loan's still going to be the 1,500, but this time we're going to take the less aggressive loan, which is going to be at the 11%. So if we multiply this out, this is going to be the 1,500 times the 11%. And then the earnings are going to be the 225 minus the 165. All right, and then we're going to do the opposite. We're going to say, now let's say we have high liquidity. So now we got more liquidity on the asset side, less risky on the asset side, and short-term financing, however, more risky on the financing side of things. All right, what's that going to look like? Once again, I'll format this. I'm going to bring over the text by saying equals the text. I'm going to say Control C, down arrow, holding down Shift, down, 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 Control V. Oh, I missed the V. Control C, down, 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 Control V. And then I'm going to format paint the entire thing. Selecting the entire thing. I'm going to hit the format painter here. I just need to hit the top box and it'll do the whole thing because the cells are the same size that we had format painted. And then we're going to say this is going to be equal to the assets, 1,500. The return on assets now, we're going to be picking up the 12%, which is the plan one with more liquid assets. So now we have more liquid assets, which is less risky. So the 12% is going to be equal to the 1,500 times the 12%. And then we're going to be picking up the loan. So we'll pick up the loan amount, and then we'll pick up the rate on the loan, which we're going to pick up the more risky loan. What the 9% on the loan for the short-term loan, because we picked up on the asset side, we picked up the less risky assets, and now we're picking up the more risky loan. Okay, so this is going to be the 1,500 times 9%. This will be equal to the 180 minus the 135, 45. So again, notice you could see the difference in the options that happen here. But notice again, this is also going to feed into whatever your strategy is as you think of whatever your competitive advantage is within the market, and then try to be aggressive where you need to be aggressive, and possibly hedge where you could hedge, so you could still find some moderation in your plan in case so you can guard against or hedge against problems.